the founder and CEO of Exante Data. Jens, is the plan implied by the forecasts achievable?
Well, so the plan is changing very, very fast, right? If you compare the dot plot from December to the dot plot we had here in March, right, we had literally 100 basis points change in what they're expecting for this year. So these plans are in flux. I think we are facing clearly the biggest inflationary challenge we have for several decades, and the Fed is ready to do something about it. They went at this meeting, they're going to go at the next several meetings. And I think at the next several meetings, the debate is not going to be about where they go, it's going to be about whether they accelerate the pace. So I think there is going to be a debate about 50 basis points, certainly in May and June. That's going to be something that's up for discussion. And you can see that in how the dots are spread out, right? We have now a significant minority that actually believes that they should do more than 25 at each meeting. So the Fed is definitely shifting gear, and they've totally revised their outlook relative to 3 months ago.
Jens, we were talking about this yesterday, how the projection from the Fed is a 3.4% unemployment rate at the end of this year, at the end of next year, and just tipping up a little bit in 2025. Is that achievable, basically, with this type of rate hiking cycle, to not have any impact on employment and other base, broad economic metrics?
What is so tricky about this cycle is that we have so much inflation, right, that it really matters whether you look at the nominal rate they are delivering or the real rate. The real rate on any measure is just incredibly low, right? So even the people who look at like financial conditions tightening, if you do that in nominal space, okay, it looks like we're getting back to sort of normal degree of tightness. If you do it in real space, conditions are still extremely easy. So this is something that's very, very tricky to sort of calibrate. Is it actually tight? I would also say, like, if you look at the housing market, we have a housing market that is just totally different from the pre-global financial crisis period, because there's essentially like an undersupply, right? So that undersupply needs to get sorted out before the interest rates are going to start to bite, even in that sector, which is typically the first you look at to see whether the monetary policy is starting to have an impact on the economy.
So this is a soup, Jens, and basically people are saying the Fed doesn't know, we don't know, so we're going to come up with our own projection and follow that, not necessarily what the Fed is saying. Which market do you buy? You saw pessimism from bonds, you saw pessimism from the dollar, you saw a surge in optimism in equities.
So I would say on Fed day or ECB day, it is very, very often that you have extremely erratic price action after the big news is out, partly because you have people on the sidelines that don't want to make a big bet into the event, and they make the bet that they would want to make otherwise once the uncertainty is out of the way. So I think there's been an element of that, especially considering that we've had this incredible period of volatility since the Russian invasion, right, that has really distorted everything, created like risk aversion, and therefore getting those events out of the way might have been the reason we had the volatility, as opposed to any specific read on the news that came out on the day.
Yeah, and Lisa mentioned the weaker dollar. Have we already seen the peak of dollar strength now that the hiking cycle has started, or is this cycle different?
Yeah, so if you analyze hiking cycles historically, you will find that typically in the run-up to the first hike, like the sort of 6 months into the hike, was typically the period in which the dollar did the best. So that's the historical experience. The question is whether that historical experience really applies to this cycle. And it really comes down to kind of like, what is the terminal rate? Like, how much can this economy really take? Is it a 1% peak in rate, 2%, 3%, or something different, right? And I do think we are an economy that is just totally different from the last cycle, at least. And therefore, the notion that we cannot get rates above 2 and we'll have a recession before that is probably too pessimistic. I think the Fed is going to be going aggressively at the next several meetings, and certainly for dollar yen, where rates are totally stuck in Japan still, I think the upward pressure that you've seen in recent weeks can be sustained.
Jens, let's finish on this. The Federal Reserve Chair is confident that this economy is strong. It can withstand a tightening cycle. It can even flourish. Jens, should that worry me or give me confidence?
Well, I think one indicator that I like to look at is what is the nominal income growth in the U.S. economy. Nominal incomes, when you add up both the wage gains and the fact that there are job gains that are pretty significant, is around 10%. 10% year on year, and the momentum is still 10%, right? So we do have forward momentum in the economy, and we're coming from such a high level of growth. The growth is going to slow, but I tend to agree with Powell. This is not an economy that's going to go quickly into recession, and this economy will be able to take some rate hikes before it starts to bite.
Jens Nordvig, thank you, sir, of Exante Data.